Hi, everyone. And essentially, in this period of confusion where we're getting bombarded every single day with a ton of information on the markets, it's also relatively hard to figure out what's going on. I thought it'd be useful just to give some perspective and give a slightly more longer term perspective. Right. I think we've got a lot, most people in. Right. So, where do we go now? Where are we and where are we going now? This is mostly on financial markets, debt and equities, as well as the underlying real economy. This probably seems very familiar to most people in the room right now. The times that we live in, we've seen a stock market that's dropped by more than 30%. And this crash came roughly after 10 years of low interest rates. It's a narrative that probably sounds very familiar. And what we've seen in the last 2 to 3 weeks, or for slightly longer, is the financial community has been reassured now after, the biggest bankers stepped in and curbed the panic selling. No matter how familiar it sounds, it's actually from a very, very long gone by era. This is back in the Great Depression in the US back in 1929, this chart that I was showing you. So the interest rates actually dropped from 2% to negative interest rates. So it's not the first time we've gone to negative interest rates. And more importantly, back then, Charles C. Mitchell, who was the chairman of National City Bank, which we today know as Citibank, stepped in together with a consortium of Chase and a few other large American banks to curb the panic selling that we saw in the markets back in the 1929-30 depression. So the Federal Reserve, as we know it today, didn't yet have the mandate and the powers it does today. So this is pre-Banking Act in 1935. If we look at it today and what we are experiencing at the moment, it's a strange sense of deja vu. Stock markets have dropped by more than 30%. It's on the back of a 10-year bull run that was fueled mostly by really low interest rates. And the financial community has been reassured after the Federal Reserve Bank has stepped in. We've sort of started at 2.3 trillion in loans and a lot of security purchases, especially debt securities. This was a little bit more just to grab everyone's attention and just bring you to a space to understand that what we are living today is quite unprecedented, and something of this scale was really almost 100 years back, and nothing in memory of anyone living today is even comparable. So just to move on to somebody that a lot of us would be familiar with, Ray Dalio, a really strong macroeconomist, runs the second largest hedge fund in the world, Bridgewater Associates. What he's mostly worried about is that majority of companies and governments around the world, there's going to be big hits to their incomes and balance sheets in various countries. And you're probably seeing this wherever you're based, whatever kind of businesses you're running. There'll be a very big difference between people who will get access to money and people who will not get access to money. And that divergence will be quite pronounced from economy to economy. This is not just a recession. It's a full breakdown in the operation of money and credit. That's a very strong statement. Anyone who's interested, you can see his full interview for an hour on TED Talks. We'll give you a good idea of what he's really thinking through. Now, how is this playing out? So if we take the world's largest companies, we'll take the 3,400 top companies globally across US, Japan, China. The Nikkei Asian Review estimates that if sales drop at the rate they have been dropping, we're expecting about 24% of the world's large companies to really run out of cash, within the next sort of year or so. And you're starting to see the first impact of this in the US. 240 billion has been drawn down from credit facilities since just March 5th. Just to give you context, these lines that we're looking at on the right-hand side of this chart generally live around 0 to 1%. This is only used for corporate cash emergencies. They have quite high interest rates, and these have quite negative impact on investor sentiment when a company starts accessing a lot of these kind of facilities. When we think about more the credit side of the house, we're also seeing the fastest pace of downgrades since 2002. And this is being led by the top three ratings agencies, S&P Global, Moody's, and Fitch. So if you look at the left-hand side chart, uh, post-COVID-19, you can see how drastic that rate of downgrades has been. And it compares it with few previous crises that we have witnessed. This is much steeper in terms of the kind of defaults and quality of credit deterioration than we have ever seen before in recorded history. Similarly, because of this, at this very juncture where we are estimating just 2020, not even going into 2021, bankruptcies will be at least as bad as the GFC, if not worse. We could be seeing bankruptcies even higher than 1991, which was a pretty rough year in America. Now, here comes the dilemma, and this is probably, the way I want to organize this session is I'm going to talk for another probably 4 or 5 minutes. Then I want to pause and take questions and hopefully have a discussion between the people present. And then I'll give my view finally at the end. So here's the dilemma that we're looking at. If we think about the recorded history of US Treasury yields, we are at the lowest point in 150 years. So while the Fed announcing that, oh, we're going to go to zero interest rates for as long as it takes for the economy to recover, might have helped the markets recover for 4 or 5 weeks, that's not a very good position for our economy to be in. We lose any ability to control future activity and what might happen later. While that's going on in the US, what you're noticing in emerging markets, especially for the corporates who really need to borrow money, so in an era of extremely negative government interest rates, corporate borrowing is actually spiking through the roof. What that translates to is any large emerging market corporate today is paying about 3 to 4% more than it was just a month ago, just to access credit to keep its operations running. And that's led to a very interesting phenomenon. So fallen angels essentially is a terminology used in markets for companies that used to be investment grade and now have been downgraded to junk or yield. Now, what is really investment grade and junk and yield, and why does it really matter? So very large companies like Ford, for example, is a great instance of this situation. It's a company with a long operating track record, has been largely a very financially sound and strong company. And as a result of that, has been investment grade for most of its existence. Now, companies like that are traditionally, the bonds they issue are what finances all of our pension funds. It finances all of our insurance claims as individuals around the world. What we are witnessing at the moment is already we're at the highest point since 1995 of where a lot of investment grade issuers are dropping into junk, which means our pension funds can't hold their bonds anymore. Our pension asset liability mismatches get bigger, which is already a large concern in most G20 developed economies. Now, I've got a question. Let me have a look at that. Daniel, that's a great question. I'll revisit that right as we get to the pause, in roughly about 2 to 3 more minutes. So as a result of this, the challenge we are facing is that we're going to start running out of first sufficient issues that can be bought by your collective savings agencies, organizations like pension funds, sovereign wealth funds, as well as life insurance companies, which creates long-term challenges. A lot of people who today would be retiring in 15 to 20 years, they're most likely not going to get anything. At the other end of the spectrum, immediately right now, what this points to is the quality of degradation that's happening to balance sheets and the holes that are popping up in most large companies around the world. Interesting thing to note here is if you look at all these downgrades, we're still being dominated by the US. There is a slight behavioral tendency where the European ratings agencies and the staff of the same ratings agencies in Europe and the rest of the world tend to be a little bit slower. So we haven't even started seeing the 2020 downgrades coming from Europe. If you look at 2015, which is when we had the European credit crisis with Spain and Italy and all of that, expect the rest of this year to look pretty nasty as Europe slowly kicks back in. However, when we start looking at the stock market, it's a completely different story. So the sell-off of 30% in February to March this year is the quickest 30% drop we have ever seen in the stock market, in entire recorded history of the stock market. And we're almost back up. Now, the fascinating thing is when you look at the right-hand chart, and let me just explain what you're looking at. On the right-hand side, the green line is where NASDAQ, which is the main composite of all the technology companies listed, in the U.S. And the red line, it represents what's their earnings per share over the next 12 months. What is most of the industry expecting that? Usually, these two lines will move in tandem. What we're witnessing from the third week of March, pretty much when the Fed stepped in and started supporting the economy, the stock market's really going ballistic, and we're seeing a classic bear market rally, while the actual expectations of these companies' future over the next 12 months looks quite dire. Now, as we think about all these aspects, what's very important to take into consideration is what we are witnessing globally is a large aggregate demand shock. What that means is suddenly companies or individuals who would be buying a lot of products and services have been put in a situation where they can't. The only way to get out of that is to socialize or collectively subsidize that massive aggregate demand gap. And different countries are doing it in different ways. And the reason I want to focus a bit on this slide is because this will decide how different countries come out of the situation. So if you look at the headlines on the left, what's the percentage of GDP that's been explicitly sort of promised by different countries into their local economies? You've got the United States at 10%, Germany at a whopping 32%, which is really significant. And then you've got Malaysia, Singapore, and Britain putting in a fair chunk to support. However, when we go into the details, it's quite interesting. Especially, I'm going to contrast Germany and US. I'm sorry, guys, the information was only available on developed nations, so I'm going to just focus on that. There's three different ways we can categorize the fiscal response that we're seeing at the moment. Direct fiscal stimulus, which is the green lines, is essentially direct loans or any taxes that the company is deferring. And they might be canceling these taxes as well as it includes the amount of purchases of securities in the open-ended market. So you'll see the United States has gone in very heavy on this side of things. Now, the purple line is more deferred obligations. So things like, your mortgage payments, or you could have social security contributions. So in the UK, you've got your pension contributions or your utility bills if you're in a country where the utility companies are largely state-owned. So in that situation, that's been pushed back further. Now, finally, liquidity for firms and wage guarantees is just to ensure that people don't lose their jobs. So there, Germany's gone really ballistic, and that's what they're trying to ensure, that the number of jobs fallout is really low, because the United States pulls back and keeps it at a pretty minimal level, if you might. Now, final chart before we do questions and answers and a discussion on this. So generally, when you think about how markets have progressed, I'm giving you a really broader picture. This is again the U.S. markets, just because we've got data going back that far. What you usually see is a bull market that lasts about 6 years and a bear market that lasts about a year and a half. We're literally at the start of a new bear market, Our last bull market is one of the longest bull markets ever seen in the history of the US for 11 years, where the stock markets really went up by almost 400%. Is this time really going to be different? If we look at the markets today and where stock markets think that the worst is really over, or is it going to be catastrophic like the bond markets are seeming to price? We're at a unique situation where the bond markets seem to think it's a nuclear meltdown, as the stock markets think we've just managed to launch the first human into Mars. So I'll pause here before I give sort of my opinions on what we will see play out. Guys, any questions or thoughts at this moment that you want to share? Otherwise, I'll start with Daniel's question.
Can I just jump in real quick? This is Joe Rotundi.
Hey, Joe.
Hey, so I noticed when I see sort of analyses of what's happening right now, including a lot of good statistics and a good analysis you have there, is the terms like to support the economy, like the stimulus, the different types of stimulus, different countries, different ways to support the economy. And what I think then is, okay, this person's sort of looking at it from a Keynesian point of view, as opposed to sort of an Austrian economic point of view, where they're not really supporting the economy, they're more just trying to reblow the bubble up that was there before. So I think the commenter in the chat box mentioned Ray Dalio, so did you. I watched his video recently, somebody sent it to me, and it seems like that's the one thing that he's missing, is he's saying you can have this beautiful deleveraging where it can kind of maintain stability. But I've heard this analogy of, well, what if you have, try to pull a cloth out from underneath the dishes? That's the magic trick they're trying to pull. But the Austrian view is they're trying to pull the table out from underneath the cloth and leave the dishes suspended in midair. And that's an impossible trick. So what do you think about that? What's your take?
That's a great intervention, Joe, because when personal thought here, a lot of the open market operations we're seeing, or large scale security purchases, is literally just reinflating an asset bubble that we already were probably 5 or 6 years into. That is not support of the underlying real economy. It doesn't create new productivity activity. It doesn't create new investment activity. It doesn't create new employment. So it's almost like a sustenance of a false economy perspective, with the hope that will lead to real investment. And that kind of a second or third degree hope, I don't know if we can bet on that this time. Back in 2008 and 2009, it was a financialized crisis, so we could get out of it. The real economy hit was really small. So if you think about the global financial crisis, we have already dropped in Q1 in the US, in the real economy, a lot bigger than we dropped in the entire GFC. And in Q1, January and February are fine in the US. The real damage is going to happen now in Q2. And some people are anticipating Q2 could be a negative 8 to 10% drop in the US. So this current strategy being followed in the US may not be the smartest thing. On the other hand, if you look at what Germany's doing, Germany's approach is a lot more pragmatic. It's a lot more, they can actually provide an accountability of who's the end recipient of the support that is being given. There's a lot more accountability in this approach. And their markets may not bounce back that quickly. Their overall GDP numbers may not reflate that quickly. But I think at an individual per capita level, they will maintain lower levels of disparity and probably greater levels of real economic support. I hope, Joe, that gives some context to your question.
Do you mind elaborating on that a bit? I mean, your points are well taken about the reaction of the various governments and all the monetary and financial stimulus. What do you think would be a more appropriate course of action, and one that's in keeping with the sanitary objectives as well? I mean, maybe elaborating on what Germany is doing, or what other kind of actions would you think are more sensible?
Yeah, thank you for that question. And again, this is just a view as an individual. I've got a background as a macroeconomist. I've been trading in markets for 15 years and just an individual view. When you look across different countries, I think it's a reflection of an underlying value system as well, where what do we want to preserve in different economies and in different societies. I personally, I'm in big favor of the German approach, where it's about save the Germans, the companies will ultimately take care of themselves as we get into the future. Whereas in America, we've taken an approach more of let's save the companies first, they will then create the future jobs. So even if we have more jobless people at the moment, we'll get them back into the place. Now, when it comes to more the virus and how to handle the virus, that's way out of my depth. I won't be able to offer any views on that. But from a real economy perspective, I think the longer we can either freeze, because what we've got is an aggregate demand shock, which means people have just stopped buying, companies have just stopped buying. In that situation, if we can freeze liabilities or just push liabilities back, Singapore did something relatively simple and smart, which was every single person's mortgage payments, the amounts don't change, they just get pushed back by about 8 months. For the next 8 months, no one in Singapore pays any mortgage. So what that ultimately helps you achieve, the banks don't make less money, but what that helps you achieve in these difficult times, you're not putting pressure. Whereas if you furlough those payments, what happens is, yeah, you get a holiday for 3 months, but on the fourth month, you've got to pay for all 4 months. It's a little bit ridiculous to assume a person who hasn't had a job for 3 months, and before those 3 months, his mortgage was already 20 or 30% of his monthly income, is now going to magically have money to pay for 4 months. That's just not going to happen. So I think some of the policies that have been implemented, there might be a disconnect with how the average human being is living his life.
Thanks.
Throw something else in there. Sorry.
Yeah, sure, Joe.
So what about the idea of just letting, because letting things collapse? If you have companies and people that don't have any savings, largely because the central bank for so long central banks have kept rates so low, discouraged saving, encouraged borrowing of, the savings get dissipated into consumption over all this time. So now people don't have anything for a rainy day, and you have to have the government steal essentially from, the currency
from the
or
overall public. Absolutely.
So what if you just let, the economy restructure itself without a central planner of the price of money sort of being the driver of it anymore, the central banks, and just allow the economy to restructure in a sustainable way? That's, what do you think about that?
So Canada and Australia are kind of taking an approach which is not exactly that brutal, but it's more along those lines. So what they're trying to establish is, if you've got, so first of all, Joe, back to your point, the amount of buybacks and dividends we've had in the last 12 years, where, if you look at the amount of slack companies could have had for a rainy day like this, we've just used all that up and paid a lot of dividends and share buybacks to shareholders, leaving the companies extremely lean and fully vulnerable to any potential shocks that could come in from anywhere. And so that's led to this situation. Now, if you look at what Canada, Denmark as well, and Australia are doing, is they're trying to establish bona fide companies. So first of all, they've got simple punitive restrictions, like if you're an offshore firm, if you've not paid taxes in the country, you just eliminate companies like that. Like, have you been a good corporate citizen? If you've been a good corporate citizen, then it's more about asset reconstruction and looking at your credit structure and renegotiating the covenants within your credit contracts, rather than just blanket, here's some more cash at you, which opens you up to more abuse. So that's as you know, Jose's just said, it's just politically so challenging in a lot of countries, not to provide that support today that we're doing on a blanket level, because in a lot of our democracies, politicians need to look really good.
And maybe can I add something here? The point is,
Sure.
the Fed is in a very good situation that we have low, very, very low
Interest rate.
inflation.
Yeah.
And not only very low inflation, we also have, I'm just looking at the velocity chart from the Fed, and the money velocity is unprecedented low levels. I have to go back to 1960. I still don't see how, you know, who knows a bit about macroeconomics knows that in order to get inflation, you need not only to increase the money supply, you also need to have high velocity, because money supply, well, increase of money supply times velocity creates inflation. And if people are not spending it, you can print so much money as you want, you don't get any inflation. And this is the lucky situation the Fed has in this current moment.
And in this one, I would say there's a slight measurement challenge as well at an ideological level. So BIS, Bank of Internal Settlements, which is sort of like a central bank of all central banks, what they've been pushing for 20 years, which both Japan and the US have pushed back against massively, is they've been saying the way we measure inflation is flawed. That was representative of an economy in the 60s and 70s. Inflation today should include all our asset prices, including our home prices, including stocks, and including debt. So Canada and Australia, both the central banks actually internally have an inflation measure that takes into account asset prices as well, which enables them to see a better picture of where inflation is. And hence they have not rushed into a random QE moment at the moment, unlike Europe and US have done. Of course, they're smaller countries, you know, they have more ability to control their populations, and they can target their better mechanisms for both sending cash and getting cash back, and being able to direct the benefits they give. But that's probably two countries to keep an eye out for future monetary policy and how we should be measuring what our economy is really doing.
Yeah, I totally agree that we have hidden inflation, and that the regulators, they don't want to show the real inflation we have in order to increase the money supply, because this helps politicians and economy. And especially in this year, the United States, they have elections in November coming up, and the Fed is, although they should be independent, they are just helping Trump to get. At the moment,
it looks very captured. Even if you look at the BlackRock relationship and Fed, it looks a little bit captured. Guys, since we have 4 minutes, I'll switch back to the final slides I've got. Let me share my screen again. There we go. So I hope, can everyone see my screen? Yeah, we're good. Joe, could you give a heads up maybe? Can you see my screen? Yeah, great. All right. So where do we go now? What are we really looking at? So 3 interesting points to stare at. First one, majority of German banks have actually started imposing negative rates on their corporate clients. This is 60% of German banks. The number of American jobs lost in the last 6 weeks is more than the number of jobs created in the last 10 years. Now, if we start looking at emerging and even frontier markets, and I've just given an example of a few frontier markets here, they're already trading at distress levels. This is quite scary. I mean, Argentina, you're probably seeing they've defaulted on 1 batch. They've still got a lot of debt outstanding. We could potentially see a deluge of emerging market defaults. We're also living in a very divided world. So, you know, so far I haven't really talked about China yet. It was a lot more US and Europe focused, if you might. We're seeing very different recovery paths in China and the US. So if you look at the left, what we're seeing is both Chinese consumer and industrial activity is picking up a lot quicker. And the US, we still haven't started seeing a U-turn yet. These are some very sophisticated, high frequency economic activity indicators being maintained by Goldman Sachs. And that's the highest frequency that we've got. Unfortunately, we don't have that for Europe, but as a proxy, electricity use has started picking up in Spain and Italy, which is a very positive sign, given we can see that they're starting to peak. And, you know, it's a good place where we are. They're still fairway below normal usage, but that's a positive sign. Now, unfortunately, from a corporate profitability perspective, and this was what I was alluding to right at the start of this talk, for Q2 earnings, for stocks being, the European companies and S&P 500 being the American ones, we're expecting between 30 to 50% lower than we did before. I'll leave this as the final slide in the last minute that we've got. When we don't have data, we got to go back to opinions and how are people truly feeling. This is a survey from McKinsey that they've conducted recently post-corona, just to see where optimism levels are between both businesses as well as individuals. What you'll notice is China, Indonesia, and Nigeria are probably the three places where people are feeling most optimistic about increased spendings and about their economies going to recover. UK, France, and Spain and South Korea, not so much. So this is probably a little bit of a sign of both economies and markets that we'll see play out over the next 12 to 13 months. If I was to just put a number out there, I would expect S&P, we're probably staring at a 20% drop from where it is at the moment before the year ends. Just to put a number down there that we can discuss in a year's time. All right, guys, that was my time and my session. Thank you, everybody, for joining in. If anyone has any more questions, I'm on Telegram. Give me a buzz, and we'll carry on from there. Thanks, guys.